Hello traders, Gary Wagner here. Just about 11:40 in Honolulu, 5:40 in New York. It is Tuesday, 15th day of January 2019, and this is the Daily Report for gold and silver. Minor moves in the precious metals today, specifically gold, down less than 0.2%, a net decline today of $2.10, with gold in February's contract currently fixed at $12.8920. Silver off by about 0.5% today, a 7-cent decline, currently trading at $15.61. Platinum in essence unchanged at $8.02, and palladium in essence unchanged, down $1 at $12.81. Now, all of this with some headwinds from a stronger U.S. dollar today, the dollar reacting specifically against the euro and the pound, as the vote was unsuccessful over in Britain today. A dollar index up 34 points at 95.55. And in terms of U.S. equities, we did have a risk on environment, 155-point gain in the Dow. The NASDAQ composite gained 117 points, And lastly, the Standard & Poor's 500 gained 27 points on the day. Traders, we continue to see gold pricing narrow in terms of the range itself. It continues to be defined by the high and low that was achieved on January the 4th. The high came in at $1,300.40, and the low came in at $1,278. We are looking at a daily chart. We can certainly see that although not consecutive, we have had consistent higher lows and consistent lower highs. Also, it seems as though we will get an answer fairly soon as to which way we will see this market break, because it does appear as though we are getting closer and closer to the apex of this flag formation. And traders, one way to look at recent price action is to move into an intraday chart. This is a 240-minute chart, meaning each candlestick represents 4 hours in trading. We obviously see our defined uptrend, and then we went into this consolidation pattern. Now, what has differed between what we're witnessing on recent price activity and what we saw, let's say, in August, September, and November of last year is really a stair step in which gold pricing would spike and then, in essence, trade sideways for some time and then spike to a higher ground. And what I'm talking about is if we go back to the lows achieved on August 16th, and this is the lowest that, of course, we have seen this year, we then saw gold prices spike to a new high and then trade sideways for a while, a stair step, another spike, a stair step, and here we got a decline. But in essence, we went from November into a more defined rally and realized that this is the point in which we began to trade above our moving averages, and most importantly, we had that golden cross that occurred between the 50 and 100-day moving average, and then we finally broke above the 200-day moving average in late December prior to the end of the year. So rather than getting that stair step, what we're seeing now is truly a compression of range. And one of the ways that we can define it when we get this kind of pennant formation is basically look for a total of 5 waves and a thrust. The thrust typically is going to be to the prevalent trend direction, and we'll have to see on this particular occasion. We are long from 1268. We have stops at 78, and I am just looking to see if the market wants to break either the support or resistance line, because my sense is if it breaks the support line, we are simply going to want to pull profits and cover our long February, wait for a correction to kind of run its course, and then go into the April from the long side. However, if it breaks and breaks to the upside, then what we'll probably want to do is simply a rollover in which we'll simultaneously take profits by selling our February position and initiate a long position in April gold. And traders, I've just put up our daily candlestick chart, which really goes through and defines different key elements or points with our moving averages. Of course, we talked about the fact that really at the end of November, we had this golden cross right here. The green represents our 50-day, the blue our 100-day moving average. And what is most interesting right now is when we take a look at our longest term 200-day moving average and our shortest term 50-day moving average, it does appear as though it is setting itself up for yet another golden cross, this being the most powerful because we've got a very short term 50-day moving average, and we're comparing that to our longest term 200-day moving average, and it does appear as though we will get a cross. If we get this golden cross and at the same time we approach the apex of this flag or pennant formation here, that tells me that there's still a really strong likelihood that we will see that break to the upside. If that occurs, that break should easily take us above $1,300 per ounce, and I would look at our new resistance levels at about $1,312 to $1,325. If we get a break to the downside, then we're going to want to calculate different fib retracement points from a starting point on this leg of the rally about mid-November. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.